Live from Dubai, Ziad Awad, the CEO of Awad Capital, welcomes you. Of course, all eyes today are focused on the meeting of the European Central Bank amid widespread expectations that the central bank will move to cut interest rates by approximately 0.25%. We have seen some fluctuations in the yields of Eurozone bonds in anticipation of this decision.
Of course, the result of today's meeting will be at 42 o'clock European time, and I agree with this 25 basis points. And the market in Euro futures is also pricing in 25 basis points accordingly. And they try to stimulate their economy as you see the interaction of return.
How do you see the interaction of European bond yields with the decisions of the European Central Bank, the expectations of a 0.25% reduction? And also, how do you anticipate the future trend in European bond yields?
This means that bonds will definitely continue to be supported. The yield curve starts at the lowest point, which is 2% for 5 years, and 2.5% for 30 years. I expect that if they continue with the rate cuts, we will see more steepening, with the 5-year and 2-year yields dropping the fastest.
Regarding the United States, expectations are increasingly leaning towards the Federal Reserve lowering interest rates by 0.25 point, with a slim possibility of keeping rates unchanged. However, the previously discussed possibility of a 0.5 point cut no longer seems likely in light of recent economic data that has shown resilience and strength in the U.S. economy. So, how much do you think the interest rate will be lowered by the end of the year?
As I mentioned on this platform, the market sometimes raises its expectations beyond those of the Federal Reserve. Today, the market's expectations are almost in line with the Federal Reserve. It means approximately 2 this year and approximately 4 next year. The market for Euro-dollar futures indicates that the pricing is roughly in line with the dot plot. The pricing is in line with the dot plot. Regarding the bond market, we have seen a strong rise in interest rates on US Treasuries, reaching a level where 2-year bonds have hit 4%, which is an attractive level. I also expect that the short-term yield in Treasuries will be supported. In my opinion, the strength we saw in the dollar this month will not last. We will see some weakness in the dollar, especially against the yen. After the Federal Reserve starts its rate cuts, and after we hear some stronger comments from the Bank of Japan.
Ziad, regarding the U.S. markets, we have also seen consecutive record levels, whether in the indices or in the stocks of some technology companies. This week, we recorded all-time highs on the S&P, the Dow Jones, Apple, and Nvidia. This week has indeed seen a range of multiple record levels, and valuations have become high, especially for technology company stocks. To what extent do you think the upward trend for these growth stocks in the United States can continue?
The rally in the American stock market means that the whole world is dizzy. At the end of the day, the American market has the best companies in the world, with strong liquidity supporting it. This week, we celebrated 2 years of the bull market, and as we enter the 3rd year, most analysts say that the 3rd year the returns are expected to be a bit weaker, around 5% or 6%, which means we might see a bit more volatility. I definitely expect to see some broadening of the rally, not just in growth stocks like the Nasdaq or the Magnificent Seven. For example, the mid-caps and the Russell 2000, which includes the 2,000 smaller companies in America, had a rally and set a record this week. In fact, the Russell 2000 closed at its highest level since 2021, yesterday. Meanwhile, the S&P has been making new highs every week. And now we are seeing a bit of catch-up from the Russell and also from the RSP, or the S&P 493, which is the S&P without the 7 largest companies. I expect to see more of this, and also anticipate that the rally will finally reach the emerging markets, not just China and India, which we have seen are strong. I expect to continue seeing strength in China and India, as well as in other countries like Mexico and Brazil, especially after the US elections and once the Federal Reserve completes its interest rate cuts.
However, while China and the Asian markets have been mentioned, it seems that recently, despite all the stimulus packages announced by China or the latest measures taken by the Minister of Housing and the Minister of Finance, there has been some disappointment from the markets regarding the statements we hear or the stimulus packages being launched. How do you think this package will react, especially since it always seems to disappoint?
The Chinese market is very attractive, meaning we are talking about 8 or 9 times the profits, and there are also some very impressive companies. The problem with the Chinese market has 2 main issues. The first issue, in my opinion, is the biggest problem, which is governance. People are not encouraged to know exactly what the numbers of these Chinese companies are, or whether the management will be independent and strong, without government interference in private companies in China. This is the biggest problem for foreign investors, which is somewhat political or geopolitical. The level of savings among the Chinese people is one of the highest in the world, with billions and billions of dollars that the Chinese are ready to invest in their national market. However, Chinese investors are afraid because they have weaknesses in the real estate market, having invested heavily in real estate and suffering significant losses. Thus, China faces the risk of deflation. I believe that the government has now decided to stop this level of deflation. So I expect that we will see more and more good news from China regarding support for the local economy. Hopefully, we will also see improvements in governance,